Welcome to the daily briefing from interest.co.nz. I'm David Jaston. Today we review the second quarter GDP growth, we update what is happening to the exchange rate, take a look at the latest productivity outcomes, and we'll wrap up with what the other media are reporting. Economic growth in the second quarter came in at levels that were generally above everyone's expectations. Depending on how you read the numbers, growth in the June quarter was 3.2% higher than the year before, using the production-based numbers, or 4.2% higher than the same quarter a year earlier, using the expenditure-based numbers. Either way, growth picked up in the second quarter and surprised most observers. Growth in the quarter was centred around the services sector, driven by finance and insurance, business and real estate services, and transport and storage. Mining also made a positive contribution as a result of increased extraction from the Maui and the Pohokura oil fields. A stronger than expected growth platform, coupled with a massive stimulus in the pipeline from the dairy industry and government spending, means the Reserve Bank cannot consider easing policy anytime soon. The growth outlook for the third quarter looks much more subdued and is now coming off a higher base than previously forecast. The housing market has turned sharply lower over the past 3 months, and the credit market turmoil will ensure business investment remains a drag on growth over the next 2 quarters. And consumption growth will ease further as consumers face higher debt servicing costs. But government spending is likely to continue to prop up overall growth, and there will be growth in export volumes. The New Zealand dollar has staged a remarkable recovery, pushing on up to well over 75 US cents in a few short weeks, and it certainly looks like threatening the 80 US cent level again. The relief felt by exporters after the falls from those highs in late July are no doubt turning back to pain. There's a real sense of deja vu here. Driving these movements is the sudden and somewhat unexpected reduction in US interest rates. The US dollar has fallen to record lows against the euro and many other currencies. It's the same with the Kiwi. One of the things expected from lower US rates is a growth boost in that economy, much higher inflation and a surge in commodity prices. The Australian mining sector is undergoing a resurgent boom. Whether the actual reason is realised for the lowering of US interest rates, the easing of the international credit crunch, is however open to debate. The strong growth in real GDP added some lustre to the productivity measure we track. Paid hours grew much more slowly than did economic growth, and that boosted productivity back to a more positive situation. In fact, productivity growth was about as good as it has been since 2002, and things could get better in the third quarter. Usually the number of hours worked in the economy goes down slightly in the third quarter, and with many strong price signals encouraging production, especially of our rural commodities, a core set of big industries will be running hard to boost outputs. Many businesses find it hard to attract new workers, so capital investment has been added instead to boost output. It is in times like this when such investments pay off. It also helps that the Australian economy is booming and a willing nearby market for our goods. And finally today, a quick wrap-up with some other recent news. Homeowners are becoming increasingly uneasy about keeping up with their mortgage repayments, a Research New Zealand survey says. Hopes that global credit markets might be easing have been derailed after a spike in key European bank lending rates, and data on US commercial paper suggests the lending drought is persisting. The Reserve Bank sold a net $138 million in foreign currency markets during the month, well down on the $1.5 billion it sold in July and $700 million in June, when it first used its controversial intervention power. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.